We're here in Scottsdale, Arizona this morning. Take 2 of the afternoon live here. And this is why buying a mortgage can be safer than being a landlord. This is unfiltered value here. Did you know you could buy a mortgage? Most people don't know that. And that may provide you the passive rate of return that you've been looking for out in the market. Most people don't realize this. You can actually buy a mortgage. And no, I don't mean go to the bank and take out a loan. I mean, you can literally buy the note, become the bank, and collect payments. Now, let me explain why that might be one of the smartest plays in today's market. When you buy a performing real estate note, you're stepping into the shoes of the lender. The borrower, the homeowner, is making monthly payments to you just like they would the Bank of America or Wells Fargo. Cha-ching, that means you're becoming the bank. You're collecting principal and interest every month without toilets, tenants, or turnover. So let's break that down step by step. For the layman that may be in the room or the non-accredited investor. So step 1, passive cash flow like a rental without the headache. When you own a mortgage note, you get monthly cash flow just like a landlord. But there's the difference. No calls and leaky faucets, no property management fees, no chasing tenants for rent. The borrower owns the home. You created a homeowner. They're responsible for taxes, insurance, and upkeep, and you collect payments. Also being listed on the insurance policy and a physical collateralized asset under your capital when lien position. So the equity cushion, what is that? Built-in protection now. Let's talk about safety later. When you buy a note, you're not paying the full value. You're not paying the full value of the property. You're buying the unpaid balance of the loan. But here's the kicker. The borrower already has put down a down payment into the deal when they bought the home. So scaling the game, they reduced their unpaid balance. So let me give you an example. What does that even look like? Say the property is worth $100,000 and they borrow the $100,000 less the $10,000 down payment, 10% down. You're buying the remaining note at around $90,000 or less. That means there's already a built-in equity cushion. So if for whatever reason the borrower stops paying, you have collateral. It's a collateralized lending opportunity, right? Providing you monthly cash flow. So if someone goes behind on that payment, you foreclose like the bank. What happens if the note goes sour? Well, let's get to the worst case scenario. They stop paying. What happens? You have the right to take the property back through foreclosure or repossession in manufactured housing, or a workout solution where you negotiate with the current homeowner and provide them probably a payment on the back of the loan, or some grace in order to reperform the asset. Because as note investors, we're in it for the payments at the end of the day. But there is recourse, right? You have the right to take the property back. And remember, you're still in a better position than if you'd bought this home as a rental. Why? Well, let me break it down. You're likely bought the note at a discount or at par, not at retail value. That means the buyer put money down, you acquired it less what the actual value is out on the market. So the borrower's down payment reduced your exposure. You're first in line in a first lien position, which is a senior position. You're not behind anyone else. That's one lien, first lien, only lien on the property. And in some case-specific situations, we originate seconds. But obviously that comes with the higher yield on the note and also the due diligence in order to validate the first to ensure the interest of the second. So even if there is a default on either one of those, there's recourse. You resell the home, rent it out, or originate a new note and start over with a new borrower. We got more than a couple steps here. Why this matters right now. In today's market, people are hunting for yield, but scared of risk. Everyone wants to preserve their capital more than make a higher rate of return. Why? Because interest rates are stuck. Tariffs and inflation are putting pressure on cash flow, and rentals are becoming less profitable because of maintenance costs and tenant headaches. But with notes, your cash flow that's already performing. right? It's already a performing asset and you're hedged in the contractually agreed upon returns and terms of that contract. You not only get monthly checks in the mail, excluding being a landlord, but all of the benefits of earning in real estate without owning any real estate. You get the downside protection of the borrower's equity, and that's why big institutional players, even like Warren Buffett, are in this space in general. I mean, Warren Buffett owns Clayton, Cavco, 21st Mortgage, Yes Communities. That's all in affordable housing, niche market, manufactured housing, and personal property notes. So if you don't take my word for it, take it from the biggest investor in the world, who's most prolific. Who is that? Warren Buffett. So if you're looking to diversify, protect your capital, and still earn monthly income, buying a mortgage note might be one of the smartest plays or most overlooked ways to do it. It's not theory, it's happening every day. We're doing it right now with mobile homes, manufactured housing, first lien paper, and affordable housing notes. Did you know affordable housing is a state of emergency? And we're providing the solution in niche market seller finance notes. So that's what we're doing. If you're curious, please reach out. I'll show you real examples of notes we have available today with all the numbers so you can see exactly how it works. If you don't find yourself wanting to take on a new education, or find yourself needing further confidence, or you want a bank quality return, all areas of conversation, you can reach out today at 602-888-CASH or invest today accredited in our 506c accredited investment fund, silvercrestopportunityfund.com. That's performing debt, investing like Warren Buffett, and offering accredited investors a 1-year term at 10% net paid monthly, or a 3-year term at 12% net paid quarterly, in an income-oriented investment strategy, providing you financial freedom. What is that? Call that mobile mailbox money. Appreciate you guys watching here today. This is not theory. This is real performing assets in the local market of Arizona, giving back, doing God's work, creating homeowners in a time when it's needed most. Appreciate you watching here today. Closed a $44,000 transaction this morning, and we've got a couple other $100,000 in notes, providing an investor to start stacking cash flowing assets.